Do you wonder what are the overarching big picture investing rules that you'll want to know before you buy any investment? That's what I'm going to be sharing with you in this video based on about 40 years of personally investing myself, working with my financial coaching clients, as well as creating multiple and diversified income streams over the past 15 years or so after stumbling into early retirement along with my husband. All right, hi, I'm Camille Gaines. Let me say that first. And here and on my website, retirecertain.com, I write about and talk about my investing experience. I'm not a financial advisor. I'm not trying to sell you wealth management services. I just talk about my own experiences, both investing alone as well as with financial advisors over the years. In this video, I want to share with you what I've sort of put in place and sort of rules that I think are super, super important. It's easy to get caught up in trying to figure out the next best stock or ETF or the best dividend stock. I'm often asked questions about things like that, but I think it's important to step back and start with the bigger picture rules that everybody needs to consider before investing in anything ever. The very, very first thing I want to say is to always have 6 months to 2 years of living expenses in an emergency fund or in some sort of mutual fund or cash or some sort of fund or access money that you can access easily, right? It depends on how old you are. There are a lot of variables, how many dependents you have and how secure your work is, whether you would want the 6 months or the 2 years accessible cash. But it's super, super important to have that. Whatever happens, you really need to be able to pay your bills. And if you can't, that leads to financial ruin. Now, I know that's more of a personal finance tip, so let me go on to the very next tip. You probably already know that if you're watching my channel, but I've got to throw it out because it's super, super important. I've invested through nasty, nasty bear markets where people lost everything and they don't realize how important this is. All right, so the next reason or rule, I should say, is to simply know what you want your money to do for you. What do you want your money to do? So we forget that that's why we're investing. We buy anything, a car, a coat, a home, and we know what we want. We know the results we want from that. The coat, we want it because we're going to stay warm in the winter. With our investing, we don't step back and say, what is it that I want my money to do for me? And that leads me to the very next rule, and that is to clarify really distinctly what you want in your life. What is the lifestyle that you want? From that place, you can look and see how much money you have and whether you need to invest in a way that will build wealth for you or in a way that will provide income for you. And that's the foundation of choosing an investment. It goes back to simply figuring out what you want your money to do for you, and that leads you to the right investments. Even though it sounds sort of woo-woo and life coachy and overly simplistic, honestly, I work with clients that have never really sat down and done this and thought about it because the whole world of investing just seems sort of detached from our lives and what we want in our lives. So that is the foundation, and those were a few rules thrown together there. The next rule is to understand how each asset you have is fulfilling those goals, those things that you want in your life. What happens, especially when you're older like me, is we can end up with a lot of our capital tied up in our home. And so it may be that asset, our home, is not serving us well. Maybe that's not the best thing for us. If we back up and say, what do I want with my life? And how are my investments? How is my money going to get that for me? And it may be that having an asset with a lot of capital tied up in it in an expensive home is not the best asset for us. That's not a given. It may be the perfect asset for us because our priority was to have a nice place where friends and family can come visit, where we can live in a certain area. It's all about you and what it is that you want in your life. But it's also looking at every single investment and saying, is this asset, whether it's a home or a fund or a stock that we've accumulated, whatever it is this contributing to those goals that I said I wanted? Is it generating income for me if that's what we decided we wanted? Or is it creating a capital gain, or does it have that capital gain wealth building potential? The next investing rule is to assess every asset for the type of risk that you're exposed to by owning that asset. We all know that the stock market goes through bear markets. We use language like, if the stock market crashes. The stock market will, I hate to use the term crash, it sounds so dramatic, right? But we know we will have bear markets again. That is a reality of investing. And they may not be quick little short bear markets. They may be secular, long, nasty bear markets. We know this is a reality. So it's super important to look at every investment that you have and say, what kind of risk do I have with this? It's not just stocks. With bonds, we have inflation risk. And we have the issue with the fact that bonds increase in value when interest rates go down. And so when interest rates can't really go down anymore, we have that risk related to bond ownership. So look at every investment that you have and see if it has acceptable risk for you, especially based on what you're giving up for owning that asset, because, well, it's your precious capital that you're giving up to own that asset. The next investing rule is to own assets that protect us from different types of risk. I mentioned the stock market risk, I mentioned inflation risk, but there are many other types of risk related to investing. Be aware of the different kinds of risk and ask if this particular investment is protecting us from the risk. Let me throw out an example. We own a core portfolio of paper assets, stocks, bonds, that type of thing, but we also own real estate properties. So the real estate properties protect us from inflation risk. They generate income, and they're also increasing in value, or they certainly have over the years since we bought these properties. But the thing is that they are protecting us as far as inflation goes, because real estate increases in value with inflation. Not only that, rent increases in value as well. So I like that this particular asset is diversified outside of our core portfolio, because it provides this other type of risk protection that we don't otherwise have. So look at every investment you have and say, what kind of risk do I have with it? And is it giving me something extra when it comes to risk protection? Maybe it's not an investment or an asset that you really want to hold any longer. The next investing rule is to know what you spend on investing. If you're spending 1 to 2% on wealth management fees, that money, that return, it has to be made up on the returns that you're getting. So think of it in that way, and it will help you become more conscious in not overspending on wealth management fees. It's super important to know what you're spending. If you're invested in funds, look and see how much you're paying on those funds. If you work with a financial advisor or wealth manager, find out exactly what you're paying. I work with clients that don't always know exactly what they're paying after they look at everything. You've got to make up that expense on the return side if you're spending excessive money on wealth management. The next investing rule is to truly optimize your capital. This goes back to what I was saying earlier about looking at each investment and making sure that it's really serving you in the way that you want, whether that's building wealth or paying you income. But this goes a step further. It's easy to get complacent about investing. It really is. It's one of those really important, but fortunately, usually not urgent situations, right? It's sitting there, especially when we're going through really good economic times and the markets are growing and increasing and our investments are increasing in value. It's easy to get complacent. It's super important though to look at every investment you have and say, is this the optimal use of my capital? I like to just put everything on a spreadsheet, and I'm a bit of a nerd in that way. I know there are a lot of apps and things like that, but if I have it on a spreadsheet, I can say, what if this happens? What if I moved this over here and I got this return? Or what if I generated income from this in addition to having this capital gain exposure? What is the very, very best use of our investment capital? And I think that a spreadsheet or even a whiteboard or a journal is a great place to do this brainstorming about the very best use of your capital. It's one of the most important investing rules. It helps us overcome that complacency that can set in when we say, I'm going to optimize my capital. The next investing rule is to plan for the worst and expect the best. In general, I'm an optimist. I think it's really important to be a positive person, not walking around blaming others for your situation or expecting the worst, always feeling like the other shoe's going to drop. I think as humans, we are wired, our brains are wired that way, left over from the cave dwelling days. However, I think it's really important to stay positive, but let's say, like I was saying a few minutes ago, bear markets are a reality of stock market investing. It's not if the stock market enters another bear market, it's when the stock market enters another long and extended bear market. Then this is going to happen. So plan with that. It helps you from an emotional place when it comes to investing, as well as it helps you survive with your investments intact when you plan for the worst, but you expect for the best. Remember, retire certain.